Let me go ahead and bring in our special guest, Gatis Roze. Welcome back, Gatis. I know you got a lot of good stuff ready for us, and we're going to let you take it away.
This, the title of, I have two titles for my brief presentation today. The first title is The Two Pillars of Probability Enhancement. So I'm a big proponent of everything and anything we can do to increase our probabilities of success as investors. And then the other part of the title was How to Systematically Reduce Risk and Increase Your Rewards. And I'm going to actually show you how you can do that. So we're going to be nudging probabilities. That's really what we're into with this little presentation. I feel a little bit like an entrepreneur that gets on an elevator with a venture capitalist, and the venture capitalist says, well, okay, tell me all about your company. You've got 30 seconds. Well, I'm going to try to compress 25 years of investing here into 20 slides. So it's one of those situations. We'll do the best I can. The only reason I'm putting up the bio really is that I wanted to say I started 4 successful companies before, including a NASDAQ traded equity. I retired when I was 40, and I've been managing my own money since that time, without, let me emphasize that, without the distraction of clients. So for many of you out there listening, I'm very much like you. I'm an individual investor. I've been that way. The teaching thing sort of a philanthropic gig. So the first pillar I'd like to talk to you about today is I'm using the metaphor of Russian nesting dolls. And the metaphor here is because the riches are in the smallest doll. So we start here with the big picture, which are, and I'll explain this a little bit later, the 59 asset classes that we're going to talk about. Then the second doll is your own personal portfolio of whether it's 5 to 20 asset classes, whatever you feel is manageable. And then, of course, the core and explore doll, which talks about core being John Bogle's asset protection part of your portfolio, and then the explore part being asset growth. And then we go on to the core, the smallest doll, which is how to get the best of the breed, whether we're buying stocks or ETFs or mutual funds. This is a slide directly from our book Grayson and I wrote a few years ago, and quite often we hear readers tell us that this is one of the key takeaways from the book. These are 59 unique asset classes. When you consider there's over 5,000 ETFs, each claiming to have some sort of unique approach to the market, Morningstar has hundreds of asset classes. For us to pull them down to 15, and there really aren't 59, and there really aren't any gaps here. So notice too, we're going to focus a little bit on correlations, but consider this as sort of a buffet, a plate for you to walk through these asset classes and pick up a balanced portfolio. That's really what we're after, what we're doing. In the recent chart pack, for those of you that are familiar, we've actually replaced 11 of these ETFs with new improved champions, if you will. This is another slide from the book, but these are the market stages. The graph is to take you through the historical reality of markets, and markets they cycle through these things. Asset allocation really is all about prospering in every type of market through all types of cycles. And you got to build your portfolio to embrace this reality. That's really why this slide is up here. Let me explain the format. I'm going to give you, show you a blog that you can go and revisit. These are the key points from the blog. So we'll explain that first. These are blogs from our Traders Journal blogs. So they'll follow with a slide with the actual blog title and date, so you can easily find it on StockCharts.com. But the second nesting doll concerns itself with building a portfolio. So in this blog, I put together, just intuitively, I built a sample of 6 asset classes, and you'll see those in a bit. Personally, I have 20 asset classes, but appreciate this is my full-time job, and I've been doing it a long time. So perhaps 20 is too much. But in the examples, the 3 example model portfolios, what I was trying to get across was that if you had a portfolio of 6 asset classes, one strategy is an equal weighted one where you put 16.5% equally across 6 asset classes. The strategic one is where you put anywhere from 5 to 40% in each of the 6 asset classes. And then tactical is where you're constantly shifting. You might be 5 to 40%, but you vary that from year to year. So this is the blog. I would really encourage you to look at the comments at the end that one of the readers wrote up. I thought Kumar, these are his numbers, but I would encourage you to look at Kumar's comments because he said this was a case where we actually, all 3 of these portfolios beat the benchmark and they had less of a drawdown than the market. So per his calculations, this is a free lunch. We had a higher reward for less risk. So we all want to jump on that if we can find it. This next blog I'm going to show you is simply trying to pitch you that asset allocation decisions they may not be the sexiest to go to a cocktail party and say, gosh, I bought XBI. You'd want to say, well, maybe I bought Tom's Amgen or whatever. But you constantly have to pick between, if one of your asset classes is, let's say, a biotech, you have to pick between the best mutual funds or the best ETFs, or you can certainly pick stocks as well. This blog was interesting in the sense that only 50% of my own assets are in ETFs. The other 50%, the best of breed, are mutual funds. So in mid caps, for example, I have mutual funds that top all the best ETFs. In biotech, I choose to play biotech using XBI, which tops all the other mutual funds. Balanced funds, mutual funds won. For emerging markets, ETFs won. So the key is to maintain the best of breed, whatever asset class you're looking at, and understand that you're shifting and always changing, because these things, the best of breed changes, and then you may decide to drop an asset class. But you should maintain the champion. The champion will change over time, and it depends on what your time frame. One of the things that Grayson and I are always talking about is, what's your time frame? If you're at a cocktail party talking to a day trader, that's very different than talking to a long-term investor. So the first question you ask a person is not necessarily, "Hi, Tom. Tell me a little bit about your time frame." It's that kind of thing. We actually, when Grayson and I wrote our book, and Wiley did not have room for this asset allocation DVD that we put together. We were hoping it would go in the back of the book, but they said it would become too expensive. So it sort of broke my heart. But anyway, the DVD's available at StockCharts bookstore. On to the second pillar. And I like to say, let the winds of probability enhance your investing success. Here we have a situation where I'm using the metaphor of nesting tables. And the largest table, obviously, being the asking yourself, what is the market trend? What should the allocations be? And then looking at the strongest sector, the strongest industry, and back down to the strongest stock in each of those. So think of it as we're constantly nudging probabilities, and it's really all about discipline. And this, in a nutshell, is really what the Tensile Trading approach is about. So we're asking ourselves, what's the trend? The allocation is it a large cap, mid cap, or small cap market? Is it a growth or value market, or is it an international or domestic market? So and again, understanding your own time frame. And then we move on to the sectors and the Dow industries, and then the best in stock. So in our book, we use this metaphor, but I've just for spicing up the presentation, this metaphor, obviously, you score points even through one hoop. You do not have to go all the way to the very bottom to score points. So you can actually play the market in an uptrending market, or pick the sector, or stop at picking an industry group. You don't have to pick individual stocks. I pick individual stocks in one asset class, which is large cap stocks, large cap US stocks. The rest, I'm invested across a spectrum of, I use ETFs and mutual funds. And it has worked nicely for me over the years. Don't try this with a 2-leg or 3-leg table, but in other words, without a process or an organization, some people call it a process or whatever, we refer to it as routines. Without routines, you're going to waste time, you're going to be inconsistent, you're going to miss opportunities. So if you aren't an organized kind of person, I would venture to say or submit to you that probably you're not going to be consistent. You probably should not be involved in the market. Terrible thing to say, but this is the chart pack that we just put out. And back in 2011, I began giving this to my students. It was the chart lists of my own that they could just download, and they were all pre-populated. Since 2013, we've actually gotten a whole community of users that are involved in this and updating it. And this is our 19th update. So today, StockCharts.com users can download 96 chart lists. They're all pre-populated. It's all formatted. It's all organized. I can't guess how many thousands of hours this is, but it's the ultimate probability enhancer. Let me call it that. This is an example from the chart list, but it addresses back to the pillar number 2, which was the top table. There are lots of cliches out there, but let's say, the rising tide and all that. But the bottom line is you've got to answer the question, what's the trend of the market? Is it either up, sideways, or down? And then to increase your probabilities, you've got to answer the allocation ones that I mentioned earlier. So these are all about building probabilities. And obviously, you're not going to buy in a down market or buy value in a growth market. It's that kind of thing. And that's what these chart lists are designed to do, to answer. So let's take it, let's assume that you are a buyer in this market. It's questionable, but this was a perf chart of the S&P sectors. This is table number 2. You'll see that here we have the sector that is performing best is energy. So with one click, you've answered that energy is the most attractive over the last, and assuming your time frame is 23 days or so, you're that kind of trader. So with one click, you've answered the question, which sector is the best? Where should I have my money? You could stop here. You don't need to go deeper, but let's go dig a little deeper. If you click the energy sector, you get this is another view. It's just simply a matrix. So remember, the market is a big pie that's cut up into these 9 slices. It's the same market. Different people cut it up different way, Russell and Dow and S&P. But basically, that's what we're doing. We're doing the big pie cut first. And in this case, we're showing even the matrix is supporting the fact that the energy sector is the most attractive. Table number 3 is we're looking at the industries that make up the energy sector. So in the case of energy, there are 6 Dow industry groups that are distinctive, that make up this big pie. Which is the most attractive? Well, we can see very quickly that exploration and production. So with another click, we go to the 4th part of the table, which are the stocks in that industry group in a strong sector that are most attractive. And from this, I went through a couple of these very quickly, and I just happened to pick this company. And you'll see that the first chart, the blue one on the top, is showing you how is this company doing relative to the market. And you can see it's outperforming the market. The green line is simply showing how is the sector, which we've discussed already, how is it performing relative to the market. And I use, unlike many people, I do not use the S&P 500. I use VTI, the Vanguard Total Market. So I'm comparing it to the total market. The third graph below is asking the question, how is the industry group that my stock belongs to doing relative to the sector? And you can see that this is a stock that is an industry that is outperforming its sector. And then the bottom fourth chart is showing you how is the stock relative to its brothers and sisters in the industry that it belongs to. This, you might say, oh my gosh, how could I draw this? Well, it's very easy. If you go to chart styles and you pull down, go to predefined settings, go to the very bottom, you end up with my name, Bob Schwartz, and you just use Gatis Roze, pull that up, and you get that that format. So as I mentioned earlier, sort of as a philanthropic gig, I've been teaching for 18 years now, and I calculated over 5,000 investors. And the two, I mean, there are a lot of things that go into this, but the two overriding observations, if you will, that I've made to summarize is that you need a personal methodology. Now, I've just showed you very quickly the nesting tables is the methodology that Grayson and I wrote about in our book. And then two is you need an organizational process. And in the case here that I was showing you, that process is the chart pack. That is how you grow your portfolio, you grow your wealth. It does take, those are the two essentials. So in summary, we've got the Russian dolls representing an asset allocation focus. We have the nested tables representing a methodology. And you wrap that all up into an organized process. And yes, indeed, it is possible to reduce our risks. We nudge our probabilities up ever so slightly with each attribute that we use, and we grow our returns. So it's, was that fast enough? I know some of you will complain it's like standing in front of a fire hydrant getting a drink, but in any event, for the full sort of 10-stage detailed roadmap, you can go to StockCharts.com bookstore. And the advantage of buying the book here is it's cheaper than Amazon, but it's also signed by Grayson and I. So you get that benefit. And then lastly, if you're into a truly completely transformational experience, you can join Grayson and I for a weekend in my office. For May 19th and 20th, just go to our website, which is Stock Market Mastery, stockmarketmastery.com, which we just trademarked, which we're very proud of. So thank you all for joining me. Thank you for reading my blog and supporting the Traders Journal blog. And I understand we're going to open it up for questions at this point.
Yeah, I don't know, Aaron, if you've been following on the in the chat room, but are there any specific questions, or maybe can you summarize any questions?
Sure. There actually, it's one of those when Gatis speaks, people listen, because there was really one main question, and it was about, so do the gains of owning mutual funds outweigh the transaction fees of an ETF for like assets, was what the question was.
Please go back and read that Best of Breed blog that I wrote about. That, understand, I have 20 asset classes. They're split between a core and explore. And as I mentioned earlier, core is where you're protecting your assets, and Explorer is the growth part. I have something called Super Explorer, which is an asset class, large cap stocks like Amazon and Visa that I own, that I'm really going for growth. It's my trading account. The other 19 asset classes that I cover, half of them I choose to, the best of the breed is an ETF, and the other half are mutual funds. And if you look at something like, I mentioned in the article in the blog, I mentioned biotech. I feel of all the ETFs out there, XBI is the way that I want to play biotech. Tom, I loved your Amgen, but I choose not to do biotech. I choose to make biotech an asset class, which I believe, 10 years from now, I'll be rewarded for. I'm not going to worry about the ups and downs. But there are good mutual funds out there. But in that case, that asset class, the ETF is best. For mid-cap stocks, I've used a prime cap fund. You can look that up. It's actually in the blog. It has outperformed everything and anything in the mid-cap area. And yes, it has modest fees, but its performance, if you're going to get the performance, I'm happy to pay the fees. So that's the bottom line. If you're not getting the performance, then buy the ETF. But it's a case by case, asset class by asset class situation. You cannot, don't be hoodwinked by the press to say, oh, you just have to buy ETFs. It's wrong. Please read that blog. I think the light will go on. You'll see what I mean.
Yeah.
Any more questions?
Oh, yes. They're now just flying in. So how do you decide when to buy? Do you wait until it becomes a top performer, or are you trying to get in early?
I wrote a blog about my trades, the FANG. I traded all four of the FANGs, and I wrote a blog about this. If you just Google Traders Journal FANG stocks, it's in the title. And I show you exactly when I bought into those. Basically, it's a matter of aligning. And in all those cases, the four major probabilities, back to the nesting table, we were in an uptrending market. They were in the best sector. I picked the strongest sector. They were in the strongest industry group, and they were the strongest stocks in the strongest industry in an uptrending, in the strongest sector in an uptrending market. That's what I'm talking about, aligning your probabilities. And it's a very simple concept that, of course, we spent 300 pages in the book describing, but that's really the objective. It's those little, if you can nudge those little probabilities, they all add up to something pretty phenomenal.
Hey, Gatis, just to kind of follow up on that. So if you're looking at an industry group, and the industry group has pulled back to, say, a long-term uptrend line that looks good technically, but recently has not been one of the best areas, would you look at it during that pullback, or do you wait until it actually makes that move and begins to show relative outperformance again?
I'm looking for outperformance. I will tell you that I'm a man out of control when it comes to watch lists. I'm a bit of a, I have a friend of mine, Harvey Baraban, and we joke we're just stock market junkies. So, and my wife claims I'm the world's worst retiree, because this is just it's a genetic problem with me. I think I just enjoy the market. So I love having an extensive watch list is perfectly fine, but I will wait for the train to start to move. I'm not looking to get on a train that isn't moving. Now, understand, there are sort of three separate portfolios that I trade. I have my core, VTI, Vanguard Total Index, being an example. I don't trade VTI. That's where I park money. Vanguard Healthcare is a fund I've owned for 25 years. I can't afford to sell it because of the huge capital gains in it. Is it the best fund? No, but it's fine. And then I have my Explorer, which I would call the biotech. XBI is an example of that. And then I have my Super Explorer stocks, which are the individual stocks like I mentioned Visa and MasterCard and Amazon and those sorts of things that I trade.
Now, when you look at some of those stocks, I mean, you just mentioned some stocks have obviously done very well over the years. What would trigger you to sell one of those companies? I mean, we've been going through so much volatility, and I think, all of our listeners and everyone who trades in the stock market, I mean, the toughest part, when your stocks are going up, it's easy. I mean, of course, you're just going to hold on, you're going to make money. But when you go through a period like we have for the last 2 or 3 months, and these crazy swings out of nowhere, all of a sudden with the volatility as high as it's been, how do you mentally get through periods like this? I mean, what would need to happen for you to sell something like an Amazon?
I did actually take a chunk of money and sell Amazon, and
Why did you sell some Amazon?
because it got to be, I've owned it for 10 years. So does that answer your question?
Okay, yeah, that does answer.
It's a matter of balancing a portfolio, looking at the gorillas. You have to, put the gorillas in control occasionally, and that is one of the. Not to pitch seasonality, but I think seasonality is a great tool to help you balance your portfolio and get it back to the percentages that make sense. And I'm a big proponent. I hope all of you answer the quiz that the question that was posed before we started about what percentage of your time as an investor do you spend on asset allocation. And it was interesting. The early goings were showing that it was sort of 20%, when it should actually be the opposite. Well, here we have it, 62%. It should actually be the opposite. It should be 80% of your time should be spent on focusing on asset allocation. It's the highest leveraged activity. That's why I know I'm sounding like a preacher, but that's why we put together that 6-hour sermon on the DVD, and we wanted to include it in the book, because it truly, for individual investors, it is a very, very powerful, high leveraged activity. Is it sexy? No. To go to a cocktail party and say, oh, I'm, using seasonality to manage my asset classes. I mean, nobody's going to want to talk to you, and you'll be in the corner drinking wine by yourself. So there's my pitch on asset allocation.
I always joke about that because I guess I do look at myself sometimes as being a geek, because I really I love the stock market. When I go on vacation, I still write my blog every day. And
welcome to the club.
Yeah, I mean, Erin and I were talking about this yesterday, and she's like, no, I just want to get away. And I said, I just love the market. So even when I'm on vacation, it's still something I really enjoy doing.
Tom, I will tell you, and I've written blogs about this, some of the best months of trading over the last 25 years have been in Hawaii. As I said, it's my happy place. I go every year, and I can't explain it. I go to Hawaii, and I just seem to relax, and I'm in touch. I'm channeling the market, and I've had some amazing trading adventures, investing adventures while being in Hawaii. So I think everybody should move to Hawaii and relax.
Well, it has certainly been a pleasure. Now, we've really enjoyed it.
It's a special pleasure for me. Thank you, Tom. Thank you, Erin. I appreciate the time together.
Hey guys, Gatis Roze here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.